Oracle, the global database giant, is betting big on cloud-based software services, and India has been at the helm of this growth. It's seen a double-digit growth in software as a service market, and that has made India one of the top-performing regions in the Asia-Pacific market. Prasad Rai, the India SaaS or Software as a Service head for Oracle, explains in this exclusive chat with me what the SaaS opportunity looks like globally, the kind of growth it is seeing, and Oracle's ambition in this opportunity. Listen in.
Out of a total software applications market of about $180 billion globally, 75 plus billion currently is from software as a service, and this is growing much faster than the traditional software. So the Indian growth as far as the SaaS is about 31 or 32% year over year, and our Fusion ERP growth, which is the cloud growth, is in excess of 50%. So we are actually outpacing the market itself and acquiring market share from the competition. And we've seen this happen not just in this financial year, we've seen that happen in the last couple of financial years too.
Okay, what is your current market share? And if you could just give us the pecking order, say, compared to a Microsoft as well as the other large players.
I would think we are very close to being the market leader as far as this is concerned. It's just a matter of a few quarters more where I think we are in a better position to be the market leader in SaaS. We have quite a few of the largest and iconic customers in India that have moved from on-premise solutions to the cloud. For example, there is State Bank of India, SBI, there is Transworld, there is Hindalco, there is Reliance, there are a bunch of other companies, including Taj Hotels, that have moved from our on-premise to the cloud-based solution. So we're seeing that migration happening and gaining momentum fairly rapidly.
Okay, your target 5 years from now?
My target 2 years from now would really be less than 2 years from now, would be to be the market leader in the SaaS marketplace. And by 5 years, I would think we want to be the dominant force as far as the cloud-based applications are concerned. And I think we are well on our way to that space.
All right, and with that, let's take a look back at how the year has been. In fact, 2018 has been a blockbuster year for mergers and acquisitions. Deal Street was a buzz throughout with some very big corporate announcements. Nisha, my colleague, is here to wrap up the big deals of 2018.
Well, thanks for that. On all parameters, 2018 has been a blockbuster year for the Deal Street. Now, deal value crossed a whopping $100 billion, and some themes were predominant. For one, the success of deals under insolvency and bankruptcy code. So, distressed asset space alone clocked in $10 billion of deals. Consolidation in many sectors was one of the key themes, and so was global deals as well. Now, I have compiled a list of top 10 deals in no particular order, and here they are. HUL got a Horlicks boost by merging GSK Health with itself, and Unilever's push really helped it clinch the deal against Nestle. Walmart, that acquired Flipkart for a whopping $16 billion, a massive one in the new age sector of e-commerce, and marks the convergence of e-tail and retail. But our good old economy sectors are not too far behind. Kumar Mangalam Birla took the leap of faith, and also Hindalco announced the acquisition of global aluminium player Aleris for $2.5 billion, largest by an Indian conglomerate overseas in the recent times. Aditya Birla Group's Ultratech also fought a fierce battle against Dalmia Bharat to acquire Binani Cement under the NCLT process, which, remember, has changed the rules of the IBC game. Another large conglomerate, Tata Group, was not too far behind in taking advantage of buying out assets under the IBC process. So Tata Steel bought Bhushan Steel. So metal deals have been really topping the chart under the IBC process. But Tata Steel, remember, also announced the formation of joint venture with ThyssenKrupp for its European operations. So it's quite a tie for the Tatas as well as the Birlas. Now, while a lot has been spoken and expected from the financial services space, a few really really fructified, and biggest amongst them was IDFC Bank and Capital First merger to create IDFC First Bank. Now, after the consolidation on the telecom sector with Idea-Vodafone merger, consolidation in cable TV space was also next in line, and that came in with Reliance buying Den Networks and Hathaway Cable. Consolidation in hospital was also a very big theme after a hotly contested battle for Fortis Healthcare, which was clinched by global player IHH. Another deal came at the fag end of this year, and that is KKR-backed Radiant buying out Max Healthcare to create the third largest hospital chain in India. A good comeback, remember, for Radiant, which was also keen on Fortis, and that is the big deal. Now, for 2019, market volatility and uncertainty ahead of elections could be a dampener.
Okay, thank you very much for that. Nimesh Shah also joins in to tell us what brokerages are recommending at the end of 2018. Nimesh, looks like we're not the only ones working.
Oh, yes, Rima. So, the few that I've picked up since morning. First, I'll start with Namuran Banks. They've written a note on PSU Bank suggesting that the latest tranche of infusion is going to be the biggest for BOI, and that probably mean that possibly that bank can be the first bank which can come out of the PCA framework. So that's what they've been betting on. But from a stock point of view, they bet on large private banks. So the preference is Axis Bank, ICICI Bank, followed by SBI. So that's a view coming in from Namura. Jefferies has written a note on FMCG companies today. They feel that the input prices for both food and non-food have come down. I have seen some correction of late, and the fact that in the last 4-5 months most of the companies have raised prices, this will go well in terms of margins for most of these FMCG companies. Valuation is a bit of a concern for them, so they've been very selective in their bets, and their top bets are ITC, Dabur, Nestle, Asian Paints and Jubilant Foodworks. So these are the bets from coming in from Jefferies. Tata Motors, where HSBC has written a note saying that the JLR weakness seems to be bottoming out now in 2019. Even in terms of valuations, absolute value is quite compelling at this point in time. But there are no upside triggers for the stock, at least in the near term, given the fact that the cash flows are going to be stressed out even in the near term. So they have a hold rating on Tata Motors with a price target of 200. Finally, MK has written a note on HDFC Bank. They feel the premium valuation for the bank will continue in the near term. The benefit of digitalization is clearly playing out for HDFC Bank, and that could be the new norm going forward. They have a target price of 2,500. And interestingly, they say that Aditya Puri may contest the continuation beyond 2020 if RBI has to change the rules of the age limit from 70 to 75. So broadly, these are the 4 or 5 large brokerage recommendations which have come out. But I think to watch out would be PSU banks and the fact that banking per se should do well in 2019.
Nimesh, thanks very much for that. Let's take a very quick break, but lined up next is a very interesting chat. Lemon Tree, the stock is up 8%. In fact, it's seeing 8 times the kind of volumes that it normally does. The company has entered into a JV, so we'll tell you all about that and also bring you the chat with the management in a bit.